Hey everyone, welcome back. We're doing something we love today, taking a deep dive into the world of real estate investing.
Yeah, we're going to be digging into an episode from the Margin World podcast and figuring out how to make those real estate investments really pay off, profitably.
Exactly. Think of this as your crash course in calculating profitability. We're talking breaking down all those financial terms into like plain English.
We want to make sure that you can go beyond just finding a place that you like, a property that you think, oh, this is nice, but actually understanding, like, do the numbers make sense? Is this going to be a smart investment for me?
Yes, absolutely. So get ready because we're about to unlock the secrets of cash flow, ROI, and a bunch more. We're going to make you a more confident, savvy investor, right?
That's right. And the first thing that any savvy investor needs to wrap their head around is the idea of cash flow. Think of this as the lifeblood of your investment, right? It's that steady stream of income that keeps everything running nice and smoothly.
Yeah, it's kind of like I guess the difference between having a car that guzzles gas and one that gets like amazing mileage, right? You want your investment to be fueling itself and leaving you with some extra cash in your pocket.
Exactly. And when we talk about calculating that cash flow, it really boils down to understanding what's coming in versus what's going out.
Okay, so let's break that down a bit.
Yeah.
Let's say you find this amazing rental property and it's bringing in like $1,500 each month.
Okay.
So that's $18,000 a year. Not bad, right? But before we get too excited,
Right.
we've got to factor in those expenses that are going to come with it.
Exactly. You've got to pay for that mortgage payment, right? And
Yeah.
that's probably going to be one of your biggest expenses. So let's say, for the sake of this example, that it's $900 a month. So now you're looking at $10,800 for the entire year. And don't forget about property taxes and insurance.
Oh, and maintenance.
And maintenance, yes.
That can be a sneaky one if you don't plan for it.
Yeah, it definitely adds up.
So is there a good way to estimate those costs up front before you jump in?
Yeah. A good rule of thumb is to budget about 1% of the property's value annually for maintenance. So let's say you're looking at a $200,000 property. You're probably going to want to set aside around $2,000 each year, just in case,
Right. Like that leaky faucet turns into like a full-on plumbing
Disaster. Yes.
situation.
Exactly. So when you add all of those expenses together, right, your mortgage, taxes, insurance, your maintenance, and you subtract that from your rental income, that final number, that's your cash flow.
And we want that to be positive cash flow. Right. That's the goal.
That is the goal, positive cash flow. It means that your rental income is actually greater than your expenses. So basically, your property is paying for itself.
Okay, I like the sound of that. But what happens if those expenses are actually more than the rent you're collecting?
That's when you're in the negative cash flow territory, which means you're dipping into your own pockets to cover those costs.
Okay. So that's not ideal, but I'm guessing there might be strategic reasons to do that maybe in the short term.
Yeah, absolutely. Maybe you've got this property in an up-and-coming area, right? You're pretty sure that the value is going to skyrocket later on, so you're willing to kind of take that temporary hit.
Okay. So it's all about strategy and kind of playing that long game sometimes.
Exactly. But generally, you want to aim for that positive cash flow. That's what's going to give you that financial stability and peace of mind, knowing that you're not constantly pouring money into this investment.
Yeah, no one wants to be stressed out about their investments.
Exactly.
The cash flow is kind of like the heartbeat of your investment. If it's not pumping strong, then you got a problem. But what about measuring the overall profitability of that investment? That's where that ROI comes into play, right?
Yeah. Return on investment, you got it. And ROI is all about understanding how efficiently those investment dollars are working for you. It's like, when you're comparing two athletes, you want to see who's delivering the most impressive results, right? Who's really maximizing their potential.
I like that. So, okay, if I buy a property for $200,000, and let's say I put down a 20% down payment, so that's $40,000, and, after a year, my rental income minus all those expenses leaves me with $5,000. That's my annual cash flow.
That's your annual cash flow, exactly.
Okay.
So to figure out your ROI, you're going to divide that annual cash flow, that $5,000, by your initial investment. Remember, that was your down payment of $40,000. So in this case, that gives you 0.125, which is a very respectable 12.5% annual return on your investment.
0.5%. All right.
Yeah.
It's a pretty great grade on a report card.
Exactly. Think of it like your investment's annual performance review.
I like it. But ROI, that's not the only factor, right? There's more to this.
There's always more to the story. It's essential to look at things like the market conditions, any potential risks, and your own personal investment timeline. All of that comes into play before making any big decisions.
So don't just fixate on that one number. Look at the whole picture.
The bigger picture, exactly. Think of it this way. Would you rather have a small slice of a very large pie or a giant slice of a teeny tiny pie?
That's a good way to put it. Okay, so we've done cash flow, we've done ROI. What other tools are in this like real estate investing toolkit to kind of help us, size up a potential investment?
Let's talk about the capitalization rate, or cap rate, as it's often called. This is kind of like your quick sniff test for a property's potential profitability.
Okay, so like, are we checking the engine before we take it for a test drive?
Exactly. It's a snapshot of its income-generating ability before we even start thinking about mortgages and all of that.
Okay.
So let's say you're looking at this property. It's bringing in about $20,000 per year in rent. After you factor in all those operating expenses, property taxes, insurance, and maintenance we talked about, you're left with a net operating income, or NOI, of $15,000. Now, let's say that property is valued at $300,000.
Okay, so we're taking that $15,000 NOI, dividing it by the $300,000 market value.
You got it. That's how we get the cap rate. And in this case, that gives us a 5% cap rate. Now, generally speaking, a higher cap rate suggests there's a potential for juicier returns.
But there's always a but, right?
Yeah.
There's more to it than just that.
You're catching on. A higher cap rate, it can sometimes mean higher risk as well, especially if you're looking in those up-and-coming areas or maybe less desirable areas. But then on the flip side, those stable, high-demand markets, they might have lower cap rates.
So again, it's about finding that balance between like potential return and how much risk you're willing to take on.
Exactly.
Kind of like choosing the spice level for your food, right?
Yeah.
You want that little kick, but not so much that that's
much.
Exactly.
All right, let's shift gears a little bit here and talk about a metric that's super relevant for investors who are using financing, the cash-on-cash return.
Ooh, this sounds interesting. What makes this different from like the ROI we talked about earlier?
So cash-on-cash return, this one zeroes in on the efficiency of your down payment, that cold, hard cash you're putting on the table up front.
So it's really about how hard that initial investment is working for you.
Exactly.
Okay, got it. So let's stick with our earlier example. We've got that $200,000 property. We put down that $40,000 down payment, and let's say it's generating a $4,000 annual cash flow. How does this cash-on-cash return work?
Okay, so to calculate that, we're going to divide that $4,000 cash flow by your down payment, which was $40,000, remember?
Right.
And that gives us a cool 10%.
Okay.
Now, this is super valuable because it really shows you the return that you're generating on the money you've actually invested, not the money that you've borrowed.
It's like, I don't know, it's like putting $10 in a slot machine and winning $20 versus putting $1,000 in and getting like $1,100 back.
Okay.
Like the ROI might look similar, right, if you just look at the percentages, but the actual amount of money that you pocketed is totally different.
Exactly. You've got it. The cash-on-cash return helps you understand how well you're using leverage.
This is all starting to make sense.
Oh.
Okay, so we've covered cash flow, we've done ROI, cap rate, and now this cash-on-cash return. I'm feeling very smart right now. I'm feeling like a real estate whiz.
Almost there. We still got a couple more things to cover. Not quite a whiz yet, but we're getting there. We've still got a few more tools to add to our real estate investing tool belt. Let's talk about the gross rent multiplier, or GRM.
Okay, GRM. I've heard of that one, I think.
This one's all about understanding how long it'll take for that rental income to cover the purchase price of the property.
Oh, that's really helpful, especially if you're thinking about like how quickly you can recoup your investment.
Exactly. It's like a countdown timer for when your property really starts paying its own way. So let's imagine you've got this great bungalow and it's listed at, say, $250,000. It's projected to bring in about $25,000 in annual rental income.
Okay.
To get to that GRM, we're simply going to divide the property price by that gross annual rental income.
So in this case, we'd be dividing that $250,000 price tag by the $25,000 in rental income.
You got it.
So that gives us a GRM of 10.
A GRM of 10, which means theoretically it would take 10 years for that rental income to cover the purchase price, assuming, of course, that everything stays consistent.
Right. Because those like market fluctuations and those unexpected expenses, those can pop up and kind of mess with our calculations.
Always. It's real estate. It's always a little bit unpredictable.
Right. So it's a good ballpark estimate, but it's not like set in stone.
Exactly. Think of it as a quick snapshot, like checking a GPS for an estimated time of arrival. It gives you a general idea, but it doesn't account for that traffic jam or that scenic detour you might take along the way.
I like that analogy. Okay, so GRM helpful, but use it with those other metrics that we've talked about.
Precisely. All right, let's switch gears for a sec and talk about something that often gets kind of overlooked, especially in those early calculations: appreciation.
Oh yeah, appreciation.
Mm-hmm.
That sounds like a fancy way of saying my property is going to be worth more money in the future.
You're on the right track. So we've been talking about cash flow and all those other important metrics. Those give us a good look at those short-term profits. But appreciation, that's the long game. It's all about the potential for your investment to actually grow in value over time.
Okay, so like if I buy a property today for, let's say, $300,000, and then a couple of years down the line, it's worth $400,000 or even more, that increase, that's appreciation, right?
You got it.
Oh,
That increase in value is appreciation.
okay, that makes sense. What are some of the things that impact how much a property appreciates?
That's where things get really, really interesting. Because, you know, appreciation isn't a guarantee.
Right.
The rate at which a property increases in value depends on a whole bunch of factors. Location's a big one. The overall health of the economy, is the area doing well?
So like a property in a really popular part of the city that's probably going to appreciate faster than like a similar place in the suburbs, right?
Exactly. Other things to think about: amenities, parks, schools, shopping centers, even public transportation. Those can all play a role.
So it's all about like finding a place that people want to live.
Yeah, a place that's desirable and
Oh,
likely to become even more desirable over time.
got it. Okay, so we got cash flow, we've got ROI, cap rate, GRM, and now appreciation. That's a lot. But I feel like we're missing something. What about those tax advantages that come with owning real estate?
Ah, yes, those tax advantages.
I've heard good things.
Real estate often comes with some pretty sweet tax benefits that can make a big difference in your overall profitability.
Okay, so what kind of tax benefits are we talking about?
For starters, you can generally deduct those recurring expenses that we've been talking about, those mortgage interest payments, property taxes.
Mm,
But the real all-star here, the MVP, if you will, of real estate tax benefits has got to be depreciation.
depreciation. Okay, that sounds a little intimidating.
It's not as scary as it sounds. Basically, depreciation lets you deduct a portion of the property's value from your taxable income every year.
Wait, so even if my property is going up in value, I can still get a tax break?
You got it.
That sounds like a win-win to me.
It can be, but of course there are, rules and regulations surrounding depreciation.
Of course, there always are.
Exactly. And the specific deductions, they can vary a bit depending on your location, the type of property you have.
So it's always a good idea to like talk to a tax professional, make sure you're doing everything right.
Always a good idea. But the key takeaway here is that these tax benefits, they can play a significant role in boosting your overall return as a real estate investor.
It's like having a secret weapon.
Exactly.
So we've covered so much in this deep dive. It's incredible. I feel like I've learned so much. We've talked about those really important profitability metrics, from cash flow and ROI all the way to appreciation and even those tax benefits.
We've covered a lot of ground.
We have. This is amazing. I feel very equipped now with all these tools in my like investing toolkit.
Absolutely, absolutely. And remember, there's no one right answer when it comes to real estate investing.
Right.
The key is to really understand your own goals, how much risk you're comfortable with, and do your research.
Research is key. I'm hearing that.
Always, always.
Okay, so we've done all of that. What else is there? Okay, so we've gone over all these different metrics. It's like having a toolbox, right, for these potential investments. But
Always.
how do we know which tools to use? It seems like it could get kind of overwhelming trying to like juggle all those numbers.
That's a great point. It's not really about juggling. It's more like, think of it like choosing the right recipe, right? Or you making a quick dinner or like a gourmet meal.
Okay, I like that.
Both can be delicious, but the ingredients and the time you put in are going to be totally different.
Right. So if I'm aiming for that quick dinner, I want that passive income, not a lot of risk, would I be focusing more on cash flow than maybe a good GRM?
Exactly. If you want consistent cash flow, maybe to like supplement your income or put into other investments, then you really want to zero in on those properties with strong positive cash flow. And yeah, a decent GRM, that can give you a rough idea of how long it'll take for that rental income to cover your purchase price. Just don't forget to factor in those other things we talked about, like location, condition of the property, all that good stuff.
Okay, so Look beyond just that one number. Got it. But what if I'm like feeling a little bolder? Like I'm ready to fire up the grill and go for that gourmet feast, try for those higher returns. What then?
If you're ready for that gourmet feast, then you're probably really interested in that appreciation potential.
Okay.
You're looking at those up-and-coming neighborhoods, areas that are maybe undergoing some revitalization or seeing a surge in demand. And in those cases, a slightly lower cash flow in the beginning might be okay, as long as you're expecting that property value to really climb over time.
So you got to be like a real estate fortune teller almost,
Well, it
trying to predict those future trends, right?
Yeah, we use data and analysis, though, more than crystal balls,
Hmm.
but you do have to think ahead.
Right. And I imagine with those higher potential returns always comes a little more risk.
Exactly. Higher risk, higher reward, as they say. That's why it's so important to really do your research. You've got to understand the market, know what's happening in the local economy. Don't just jump in blindly.
Got it. Preparation is key, just like with that gourmet meal. Speaking of which, we can't forget about those tax benefits, right?
Oh, absolutely not. Depreciation, that's a powerful tool, especially if you happen to be in a higher tax bracket.
Yeah.
Talking to a tax pro is always a smart move, just to make sure you're taking advantage of all those benefits.
It's like that secret ingredient.
Right. But those tax laws, they can be tricky. They're always changing.
Right. Stay informed.
Exactly.
Well, wow, this deep dive has been incredible. I feel like we've gone from being totally lost in this sea of financial terms to like confidently navigating the world of real estate investing.
And we've only just scratched the surface. There's always more to learn, new strategies to try out, more profits to uncover.
So to everyone listening, keep that curiosity going, keep learning, and never stop exploring those possibilities.
That's right. And we'll be here to help guide you along the way. Until next time, happy investing.
See you next time.